Well, welcome back to Module 4 of the series on the Series 65 and 66. I'm Dan Mars, your instructor. Glad to have you. I'm certainly glad that you're watching these. Hope you're getting a lot out of it. Again, if you wouldn't mind to go to the website, give us a comment, leave a comment on the video itself, like us, subscribe to the channel. Those things all help us out a whole lot. We really appreciate your help. As we try to get these things to where we have a viable business model and give these classes for free. So in any event, let's go ahead and pick back up where we were. We were at the bottom of page 4 talking about the 34 Act, the Securities, Exchange thereof, Act of 34. And where we left off, we just talked about margin accounts and Regulation T. And so another thing that the 34 Act did was it established stock exchange registration requirements. Now, I live in Tulsa, okay? So y'all come down to Tulsa, all right? And let's get together and let's start up the Tulsa Stock Exchange. What would we have to do to create the Tulsa Stock Exchange? Well, it's prescribed for us in the 34 Act. We would need to file an application. You would have to show that the Tulsa Stock Exchange is in the public interest. It would be able to serve a need, fill a need that wasn't being met, that there'd be some advantage to investors to do so. Basically, it'd be in the public interest. We would have to show that we would be able to regulate and enforce ourselves, because exchanges are self-regulatory organizations, or SROs. So we would need to be able to create rules that would ensure fair trading. We would have to assure the SEC that we would be able to enforce those rules. And we'd have to have a tripartite board of directors. Okay, some of the words that you have in this thing are because, remember, these laws were drafted by lawyers, and lawyers get paid by the syllable. And so, if you have threefold or three group, no, tripartite. That's a cooler word. So you're stuck with these things. Who all's on there? Okay, you have listed companies, representatives of listed companies, and so and then members, which would include like the folks who own seats on the exchange, and then finally a member from the representative from the general public. So those three groups all have to be represented on the board of directors of our new Tulsa Stock Exchange. And if we file the application, it becomes effective 90 days after filing the application and showing that we can do these other things. Okay, so that's what we need to do to set up a new exchange. This next bullet point, the SEC may close an exchange for up to 90 days if there's just gross negligence, fraud going on. We can't enforce our rules anymore. Yeah, the SEC can step in and up to 90 days say, look, shut it down until you get the problem solved. They can certainly do that. Remember, this was 1934, where this last part of it, they have to notify the president. Like the president wouldn't know? Don't ask me. I wasn't around in 34, so that's the rule. They have to notify the president. Look, we're closing that Tulsa Stock Exchange for whatever reason, and so like I say, you probably know about the time that the order came out. In any event, the 34 Act provided for other requirements and provisions, like for instance, broker-dealer registration with the SEC. We can't just set up a broker-dealer and start doing trades in security. No, we have to register. That's why you, if you're affiliated with a broker-dealer, why you have to take a licensing exam, because you become an agent or representative of that broker-dealer, which is itself registered with the SEC. So registration becomes effective after a 45-day review on the broker-dealer. And then other provisions of the 34 Act include a definition of investment discretion. Now, this is one where I will just almost guarantee you that you're going to have a question. You need to look at the parameters of a trade. All right, you have 5 different parameters. You have the asset, we can call it. You've got the action, whether to buy or sell. You've got the amount, the number of shares, number of face value of bonds, the thousands of face value in the bonds. You have the price that you want it to be done at, and you have the time that you want it to be done at. Now, those first three, sometimes they'll call it the AAA, the name of the security or the asset, the action, whether to buy or to sell, and the amount. Those all have to be specified by the customer. But take just a second, and again, let's take all the technology out, because now we have what? We have guaranteed, half second later execution on market orders. Yeah, that's cool, but it doesn't illustrate our point. So let's go back before there were computers at all, and we had to, telegram, or we had to call, and then somebody had to write it down and take it out to the trading post and actually make the trade right there on the spot. All right? So if I placed a market order with you, what would I say? I would say, look, I need for you to buy me 100 shares of U.S. Steel at the market. What did I say? 100 shares, U.S. Steel, buy. Those are the 3 A's. At the market, what I'm doing is I'm saying, and get the best price you can for me as soon as you can get it done. So the price of execution, time of execution, those can be at the discretion of the broker-dealer, and it's still not a discretionary trade. A market order gives the broker-dealer discretion over that. That's the purest form of it. Now, what you're likely to see is that the customer says, I've looked over your list. I'd like for you to buy me 100 shares of XYZ. It doesn't really matter what price you pay, wherever you think it looks good, whatever time you think is best for me, go ahead and do it. Okay, what that is, that's like a market not held order, and you probably won't see that on this test. But you can actually execute it right now, or you can wait until later in the day to execute that order. Because what did the customer say? Buy 100 shares, XYZ. Price and time up to you. All right? Or, I've looked over your list. I agree with you. Bank stocks are the place to be. So pick out 3 that you think are the best and buy me about $5,000 worth of each. Wait a minute. No. They're saying to buy. They're saying how much, but they're not saying which ones. That's not a valid order. That would be using discretion. All right? I agree with you. PDQ Industries is going to go one way or the other. Either buy it or sell it short, whichever you think is the best. No, that'd be a discretionary order. You need to have a signed power of attorney discretionary authorization in order to make that trade. But like I say, the 3 A's, okay, that's not discretion if that is, in fact, specified by the customer. And so some of the other provisions, again, of the 34 Act, transfer agents. I'm going to take a pause right here, okay? Because the English language is great. Because if you read something forward, then what it does is that it tells you what it is. If you read it backwards, it tells you how it works. Let me show you, okay? You're on the expressway and you need to get off. So you take the exit ramp. What is that? That's a ramp, a sloped surface, where you can exit or get off of the expressway. Read it backwards, it says how it works. So a transfer agent is someone who acts on behalf of someone else, an agent, to do what? To effect the transfer of ownership of securities. Try it. It's amazing. It just really does make a lot of these terms come clear. In fact, sometimes you can even split up individual words and do it that way. So in any event, like I said, transfer agent will affect the transfer of ownership of securities. Typically, they're going to be a bank. It's not an insurance company for its own separate accounts. And the Options Clearing Corporation, or OCC, okay, it issues, assigns, and clears options, but it does not actually transfer ownership of options. So those are all possibilities for questions that you may have regarding transfer agents. The 34 Act also set up minimum net capital requirements for broker-dealers. It did not set up net capital requirements for investment advisors. Now again, I hate to keep pausing and taking these little side trips, but these are things that you're going to have and keep in mind in order to pass the test. All right? Broker-dealers, those requirements at the federal level are pretty stiff. At the state level, They're not. In fact, they're almost to the point of being meaningless at the state level. So your chances of seeing a state question on broker-dealer net capital are pretty much nil. Okay? The fact that there's no federal requirement for net capital for investment advisors, that's a good possibility of having a question on its own. There are state requirements for state-registered investment advisors. Whether federal or state, the folks, the individuals, have no net capital requirements. Oh, are you starting to see where reading the question is going to be of paramount importance to you? Because what are they talking about on this question? Federal, state, business, individual. Yeah, and you've got to sort it out. Read those questions carefully, all right? There is no investment advisor net capital requirement at the federal level. There is one for broker-dealers. Fidelity bonds are required based upon the net capital. You're not going to be tested on the amounts. You just need to know that a fidelity bond, yeah, we got to be bonded in this industry. And then corporate filings with the SEC that are required an 8K for significant corporate events. The way I remember this one, we just bought a company. We ate them up. Oh, bad pun. Sorry about that. But the other significant events that go on, it's not limited to when we take over another company. But like I say, it's a way that I've got to remember it. A 10Q, let's see, the Q stands for quarterly. Quarterly, yeah. Financial statements have to be filed with the SEC. And then once a year, we have to file a 10K, which is audited. Well, what does the auditor say? The auditor says, this one, okay. One, okay. Yeah, there we go. That, if it'll help. Like I said, I know they're bad puns, but if it helps you remember, then there we go. And annual reports or the Form 10K then has to be sent to shareholders because the shareholders need to know what's going on. So those are, in fact, the provisions that you will need to know about the 34 Act, the Securities Exchange Thereof Act of 1934. Now, there were some amendments made to it in 1975, and so what it did, the significant components of that, it created the MSRB, Municipal Securities Rule Making Board. I'll tell you what, a couple of minutes ago we said that you could read terms backwards. Here's a great one, Municipal Securities Rule Making Board. What does this board do? They make rules regarding municipal securities. Do they enforce rules? No, they make rules. So you may need to know who enforces the rules. Okay, remember, you've got broker-dealers active in municipal bonds, you've got banks that are active in municipal bonds. Who is already in those ballparks right now acting as an umpire? All right, in the broker-dealer community, you've got FINRA, and you've got the SEC that are there. In the banking community, you've got the FDIC, the Federal Reserve Board, and the Comptroller of the Currency. This is the MSRB's rules relate to secondary market trading activity only. Now let's think back to the last session, or actually the time before that, we found out that, let's see, government, regulators, list of charities, short, that talked about exempt securities. And so since municipal bonds are exempt securities, then we want to be able to prevent fraud or misdealings in the secondary market, but we can't require a registration in the primary market. And so secondary market activities only. Another thing that the 75 amendments did was to abolish the fixed commission schedules, which just open up a whole new world of pricing models and in fact, broker-dealer business models, and allowed for the beginnings of a national market system, which really has improved the ability that we have to trade, particularly over the counter securities, and to increase activity that we see today. National Securities Markets Improvement Act of '96, or NSMIA, established the preeminence of the SEC versus state laws and regulations. Now, This is very important because of that, if the federal government's regulations are here, then the state regulations, they can go up to, maybe equal that, but they cannot exceed the requirements of federal law. If the federal government has jurisdiction over this, whatever this is, then the states are going to say, up, hands off. That's a very important concept for us to remember, okay? And it's one of the reasons why there are differences in exemptions at the state level than there are at the federal level. And speaking of, eliminated the dual registration requirements for certain securities and entities because it created federal covered securities. We'll talk about that when the time comes. Created federal covered advisors, and again we'll talk about that when the time comes. Where we are right now, because of the fact that these securities and advisors are covered by the federal government, then they're going to be exempted from registration at the state level because that federal law has preeminence over the state law. And the next one is the Investment Company Act of 1940. So let's go ahead and get into this a little bit. We'll probably be able to get a few of the bullet points before we take our break. But in any event, the definition of an investment company. 1940, it was defined as more than 40% of its assets are in securities. All right, and then banks and insurance companies are excluded. So again, what did we say when we talked about banks the first time? Yeah, it is not, will not be, cannot be. So if I buy a bank CD, that's a certificate of deposit at a bank. Okay, in fact, it is a deposit for which I get a certificate. I just read the term backwards. The banks and insurance companies are excluded, but as time has passed, what's happened is that insurance companies have come up with variable products. We'll revisit this a little bit later on. But those variable products have what they call separate accounts. The separate accounts, in fact, are considered to be securities. They are considered to be investment companies. And when we get there, we'll see what the deal is a little bit more. Passive investors, so an investment company is not a holding company. We talked about Bank of America and how they hold different companies, all right, wholly owned subsidiaries of Bank of America that you get on the New York Stock Exchange. An investment company doesn't do that. In fact, an investment company will not take a controlling interest in its target companies. All right, it's a passive investor. That's why they file that 13F, like for a fund, as opposed to the 13D to try to take over control, get representation. Can they have input? Sure, but so can you as a stockholder. Minimum of 100 shareholders and minimum assets of 100,000. Yes, that is 100,000. In the industry, we use Roman numeral M for 1,000, double M's 1,000, 1,000 is a million. And so I've just tried to be consistent here with what's used in the industry. So $100,000 minimum assets. In 1940, that was a ton of money. Now it's like pocket change. Okay, so like I said, that's one of the reasons why we have more investment companies than we do stocks on the New York Stock Exchange. So in any event, like I said, those are requirements for investment companies under the Investment Company Act of 1940. Next, we have the types of investment companies that are prescribed for us. The first of these is a face amount certificate. Be familiar with the name. Back before mortgages were fully amortizing, these things were very important because eventually they would give us the full face value of our mortgage. You don't need them anymore. They're obsolete. But every now and then they need a fourth answer on a test question. It's a valid term even though it's never used. The next is a unit investment trust. Now, if you have your securities license, you probably know about UITs, but basically the best way I've got to describe a UIT is it's a shoebox. And the easiest thing to put in the shoebox is bonds. And so you put them, you and I buy units, okay, of ownership, okay, then the investments are put into a trust or a shoebox. That is an investment, and we each buy units in it. Just read it backwards. And what happens is that the sponsor of it, now not a manager, because they're not going to turn over anything that's in the shoebox, they're just going to take care of the paperwork and write checks. And so basically, when it comes time to write out an interest check, they write us out an interest check. If this bond matures, they write us out a principal check. And eventually, that bond matures, and that one, and that one, and that one, and that, and the whole shoebox matures, and the thing just plays itself out. That's kind of the simplest form of UIT. No manager. So if you have an investment company that has no manager, it's a dead giveaway. It's a UIT, Unit Investment Trust. So if there's no manager, there's no management fee. Because I don't know about you, I'm not going to manage something and not get paid for it. Neither is anybody else in the world, okay? So if there's no manager or no management fee, it's a unit investment trust. Then you also have management companies, open-end investment companies, or mutual funds that we're very familiar with, and we'll talk about in more detail later on. Or you've got closed-end, also known as publicly traded funds. They look, they walk, they talk, just like a stock. Just like, in fact, trade on stock exchange. All right, supply and demand for the shares themselves. That's what pushes the price of those closed-end funds. And a particular type of those is an ETF, or exchange-traded fund, that will mirror an index. So we set up something that replicates the S&P 500. That's going to be a particular type of closed-end fund. It's going to be an ETF. Closed-end funds give you intraday liquidity. Like I said, the intra, just like intrastate, you get liquidity within a single day. So you can trade them back and forth on the New York Stock Exchange because they look, walk, talk, and quack just like a stock. So we've hit about 20 minutes. We'll just call this a breaking point. We'll come back and talk about diversified management companies in our next module. But in the meantime, like I say, if you wouldn't mind to leave some comments, if you like these, tell us, like them. And tell the absolute best thing that you can do to help us out is to tell your training department or your licensing officer that we're here. That really will help us out just tons. We really do appreciate that, and we'll see you back then for the next module.